Friday, March 9th, 2018, Monaco 64, home of alternative economics and contrarian views. So this is a post-jobs data update. The U.S. government, the Treasury, the Fed, they've just come out with a perfect number to keep stock markets from collapsing, to keep interest rates under control, and at the same time to give the impression that the economy is doing great. And why do I say that? Well, I've been following these numbers for over 20 years, since the late 80s, early 90s, when I started working in the markets. And I have to admit, at the time when I started out, late 80s, early 90s, I think the trade deficit numbers were more important. And then towards the early mid 90s, the job data became the most important one, and it still is. Hypothetical jobs, some people call it. So why am I saying that this was just the perfect number, for the powers that be to keep things, from wobbling? And it's still questionable whether they will be able to, because in my opinion, the big, deception that I've seen already for many years is that in spite of the economy doing so well as they claim, we still have interest rates under 2%, around 1.5%. In Europe, we have interest rates at 0 or negative. What else? We have huge budget deficits in the US. I mean, if the economy is doing well, we should be running surpluses by now, but we don't. So what did we get in terms of numbers? I wrote down like the expectations that the markets had from investing.com. It's a survey of economists. They always have that before the number. For non-farm payroll, they expected 200,000 jobs created, non-farm payroll. But the markets were really paying close attention to average hourly earnings, which is a measure of wages, and also average work week, which shows how much, how many hours people are working. And why was the market focusing on that? Well, because the Fed supposedly is looking at these to see if there's any signs of rising inflation. And as I've said in the past, I think these are just, higher wages are a consequence of inflation, not inflation itself. And I'll, make that point again. So average hourly earnings was expected to come out at 0.2% up for the month versus 0.3% the previous month. But it actually came out at 0.1%. And that little, that 1/10 makes a big difference for the markets. Because now maybe, people might not, investors and traders might not expect the Fed to hike as much. Only for that 1/10. Believe me, it does make a difference. I've been in these markets before. So, so that's all right. And at the same time, it wasn't 0. So that's pretty good. And then average work week came out at 34.5 hours, was expected 34.4, a little stronger, but I think the focus will be on the average hourly earnings. But the big deception, in my opinion, is the non-farm payroll number, which was expected 200,000 on average, and it came out at 313,000. And the previous number was revised from 200,000 to 239,000. So my question is, if the U.S. economy is creating so many jobs, wages are under control, unemployment is at 4.1%. Why does President Trump need to bring up, have tariffs? Well, on trade, if everything's going so well, how much more growth and more jobs do you need? Well, it's because the economy isn't doing well. And that, in my opinion, is the big deception. You look at the trade deficit the other day was 56 billion on the month. So that is not a sign of an economy doing well. But for now, the market's, you know, gold, no matter what happens, I guess it will have a tough day on non-farm. I think the first move right after the number came out was up to like 1320. It had been sold off prior to the number, down to 1313. And now it's at 1314, down 8. Silver's down 10. So that's the fictional U.S. financial market for you. Oh, the Dow, of course, is up 139. But we still got time until we got 45 minutes until the regular hour session. And what's happened to the bond, the 10-year yield, which is the important thing that we need to keep an eye on. I personally think even though average hourly earnings were under control, the fact that we've had this 313,000 could spook people. You know, they're trying to be too clever. They're trying to say that we have what's called a Goldilocks economy. And what's a Goldilocks economy? Well, that's an economy that grows really well and there's no inflation problem. You know, everything's great. And but I think it could spook the market because bonds actually have spiked up to 289 right after the numbers, and then it came off a bit, and right now is still at 289, the 10-year yield. So I think it will be important to keep an eye on this, even though I think the working group on financial markets, which includes the U.S. Treasury, the Federal Reserve, you know, the CFTC, SEC, and also the banks, because the banks are very closely attached to these actors. You know, they've come out with a number that I'm sure, you know, they thought, oh, this number, if we tweak it here and there, this should be okay. I don't buy into the you know, to the theory, conspiracy theory that the Bureau of Labor Statistics is an independent, you know, part of the government. I mean, they're probably being controlled by the Treasury, the Fed. You know, they're saying, oh, let's do this and that. And then you find out that a year or 18 months later, all these numbers are revised completely, but no one's looking at them, you know, 18 months from now. So that's what I get from this number. It's just another a fake number trying to keep you know, the markets from doing what they should. But I think you can fool a lot of people, most of the time, but you can't fool everyone all of the time. So it will be interesting to see. It's still early days. You know, the Dow is doing well. Gold is down. So they've got their wanted result. But I would say that the 10-year yield is giving them a little bit of a headache because right now we're testing 290. So that's the one to keep an eye on, the 10-year yield. I'll put a link below to where you can find the 10-year yield in the description. So that's it. If you enjoyed this update, please like, share it far and wide, subscribe to my channel if you haven't yet, and you can also follow me on steemit.com and on Twitter. And I'll talk to you later. Bye.